Good morning, smart money. The world's biggest food company just served up a masterclass in corporate governance, and it's about reshape how we think about executive accountability forever. Nestle, the $200 billion Swiss giant behind Kit Kat and Nescafé, just fired CEO Laurent Freix after barely 1 year in the job, following an investigation into an undisclosed romantic relationship with a direct subordinate. But here's the golden egg that everyone's missing. Freix walked away with absolutely zero severance, move that's almost unheard of in the C-suite. Let's crack this golden egg and see what's inside, because this isn't just another corporate scandal. This is a seismic shift in how boards are finally treating reputational risk as seriously as financial risk. The loss of 2 CEOs and a chairman in 1 year represents historic proportions for Nestle, coming after Mark Schneider's ouster last year, and just months after longtime chair Paul Bulcke announced he would step down in 2026. We're witnessing the most turbulent period in the company's 159-year history, and smart money needs to understand what this means for the broader market. Here's where the story gets fascinating. Concerns about Freix's relationship first emerged through an internal company hotline in the spring. The board immediately opened an investigation, but it was inconclusive. When concerns persisted, they launched a second probe with an external counsel, which confirmed the relationship. Freix had initially denied the relationship to the board, a critical detail that transformed this from a disclosure issue into a credibility crisis. The market's reaction tells us everything we need to know about investor sentiment. Nestlé shares dropped 1% following the announcement, adding to the company's struggles, with shares losing almost a third of their value over the past 5 years and shedding 17% during Freix's leadership. But here's the deeper story. Analysts still maintain a buy rating with an average 12-month price target of CHF 86.55, suggesting 15.51% upside potential. Now, let's talk about the golden lifeboat in this storm. Philipp Navratil, the new CEO who's stepping up from Nespresso. This isn't just another corporate reshuffle, it's a strategic masterstroke. Navratil brings over 2 decades of Nestlé experience, starting as an international auditor in 2001 and rising to country manager for Honduras in 2009. In 2013, he took leadership of the coffee and beverage business in Mexico, then became senior vice president of Nestlé's coffee strategic business unit in 2020, a division that's been Nestlé's consistent growth engine. Here's why this matters for your portfolio. Coffee represents one of Nestlé's most profitable segments, and Navratil just delivered notable category growth of 5.1% in coffee and 8.9% in confectionery in Q1 2025. With extensive background in the coffee industry and a reputation for collaborative, inclusive management style, he's positioned to stabilize operations while capitalizing on premium coffee trends. But let's zoom out to the bigger picture, because this scandal is part of a massive trend reshaping corporate America. This sudden exit joins the latest management reshuffles at global consumer goods companies this year, including Unilever, Diageo, and Hershey, as top management conduct comes under intense scrutiny. Kohl's fired CEO Ashley Buchanan in May after just 100 days for deals with a vendor he had personal relationships with, and Astronomer CEO Andy Byron resigned in July after being caught embracing a staffer at a Coldplay concert. The governance revolution is real, and it's accelerating. For years, high-profile executives who crossed ethical lines left with multi-million-dollar parachutes. Famously, McDonald's former CEO Steve Easterbrook walked away with $40 million after a consensual relationship with a subordinate. According to corporate governance veteran Nell Minow, Nestlé's decision to deny Freixenet any severance is really unusual and represents a badge of success for corporate governance. Nestlé's move may prove a turning point. By denying Freixenet a golden parachute, the Swiss food giant signaled that boards are treating reputational risk as seriously as financial risk, and missteps at the top no longer guarantee a cushy landing. This creates immediate investment implications across multiple sectors. Consumer goods companies are now under the microscope for governance practices, creating both risks and opportunities. Companies with strong governance frameworks and transparent policies are likely to command premium valuations, while those with weak oversight face increased volatility. For Nestlé specifically, the challenges are mounting. The company faces the growing Watergate scandal, with its water division under investigation for illegal filtration, high international coffee prices, pressuring margins, slowing sales, historically high cocoa prices, and a falling share price. This marks Nestlé's third CEO change in just over a year, heightening investor concern over strategic consistency while facing competitive pressure from the newly merged Keurig Dr. Pepper JD Peet's in coffee. Yet here's the contrarian opportunity that smart money should recognize. Analyst Patrick Schwendemann notes that while the CEO change could lead to paralyzing uncertainty, it could also accelerate the company's recovery, with Swiss Philipp Navratil representing a good Swiss compromise between predecessors. The broader market implications are profound. We're seeing a fundamental shift in how investors value corporate governance. ESG investing isn't just about environmental and social factors anymore. The governance component is becoming the primary driver of institutional investment decisions. Companies that demonstrate zero-tolerance policies for executive misconduct are likely to attract capital at lower costs, while those with weak governance face higher risk premiums. This trend extends beyond individual companies to entire sectors. The consumer goods industry, traditionally seen as stable and predictable, is experiencing unprecedented leadership volatility. This creates opportunities for agile investors to identify companies with strong governance frameworks before the market fully prices in the governance premium. For active portfolio managers, this represents a clear screening criterion. Companies with transparent disclosure policies, independent board oversight, and clear consequences for misconduct are positioning themselves for outperformance in an environment where governance failures can trigger immediate value destruction. The timing is particularly significant given current market conditions. With inflation pressures, supply chain disruptions, and geopolitical tensions already challenging consumer goods companies, governance failures represent an additional layer of risk that institutional investors can no longer ignore. Here's your golden takeaway from this corporate earthquake. First, governance is becoming the new alpha. Companies that proactively strengthen their oversight mechanisms and demonstrate zero tolerance for executive misconduct will command premium valuations. Second, leadership stability in consumer goods is the new scarcity. Nestlé's third CEO in 2 years highlights how rare, consistent leadership has become, making companies with stable, ethical leadership increasingly valuable. Third, the era of golden parachutes for misconduct is ending. Nestlé's decision to deny Freixenet any severance signals a fundamental shift in how boards balance shareholder interests against executive protection. For immediate action, watch how other consumer goods companies respond to this governance revolution. Companies that voluntarily strengthen their policies and demonstrate proactive governance will likely outperform those that wait for scandals to force change. The market is sending a clear signal. Ethical leadership isn't just morally right, it's becoming financially essential. The Nestlé situation also creates a specific investment thesis. While the company faces near-term uncertainty with its third CEO change, Navratil's coffee expertise positions him to capitalize on the premium coffee trend that's driving industry growth. His track record of delivering growth in challenging markets, combined with Nestlé's dominant market position, creates a potential value opportunity for patient investors willing to navigate the short-term volatility. Looking ahead, expect this governance revolution to accelerate. Institutional investors are increasingly using governance metrics as primary screening criteria, and companies with weak oversight will face capital flight. The smart money play is identifying companies that are ahead of this curve, implementing strong governance frameworks before they're forced to by scandals or investor pressure. This isn't just about avoiding governance failures, it's about recognizing that in an era of increased transparency and social media scrutiny, governance excellence is becoming a competitive advantage. Companies that embrace this reality will outperform those that view governance as a compliance burden rather than a value driver. Keep your eyes on the golden opportunities, because in this new era of corporate accountability, the companies that govern best will perform best. The Nestlé scandal isn't just ending one CEO's career, it's beginning a new chapter in how markets value ethical leadership and corporate responsibility.